So, what if I told you that the monthly portfolio statement your financial advisor sends you?
Right, the ones showing all that hard work they do.
Yeah, exactly. The one showing them constantly, rebalancing your investments. What if I told you that busy work is actually costing you hundreds of thousands of dollars?
It really is the ultimate illusion of control.
Yeah.
We ran every single rebalancing rule we could think of on 63 years of U.S. market data. And the answer is completely counterintuitive.
Completely.
Right? For a normal 60/40 portfolio, the frequency of your rebalancing barely matters. The laziest possible approach actually wins.
And here is the massive twist that we're going to unpack today. If you are running a levered portfolio, the math completely flips on its head.
Exactly. Same assets, opposite answer on timing. We're going to explain exactly why.
Because, we're told by advisors, by textbooks, by just basic common sense that we have to rebalance on a strict schedule. It's like that little sticker in the corner of your car's windshield telling you to get an oil change.
Yeah, you feel like if you ignore it, you're going to damage the machine. We crave that certainty. But nobody ever really pauses to rigorously test it.
With real data and real transaction costs.
Exactly. So we brought the receipts. For this deep dive, we're looking at a massive study using the CRSP database.
And for those who aren't data nerds, that is the gold standard database tracking the entire U.S. stock market.
Right. It includes all dividends, and it accounts for delisted stocks. So there is no survivorship bias. It's the real, unvarnished history of the market.
And for the bond side, what are we looking at, just to be clear?
We used Efrajet constant maturity treasury yields. And I should note, all the returns we'll talk about today are simple arithmetic returns.
Okay, got it.
And when we mention the Sharpe ratio, which is really just the finance industry's way of measuring how much return you get for the risk you take, we're using excess returns over a 4.5% average treasury bill rate.
So we are talking about a very rigorous setup. This isn't just like a quick 10-year backtest on a modern ETF.
No, not at all. We are looking at nearly 15,800 trading days, from January 1962 all the way to December 2024.
Okay, so we have the absolute gold standard data. The mission for today's deep dive is simple. Find out if this financial busy work is actually worth it.
And we know we have two different types of listeners today.
Right. Half of you listening are regular folks staring at your 401ks, just wondering if you're doing it right. And the other half are portfolio managers and quants running billions of dollars.
And both groups are going to hear something today that completely shatters conventional wisdom.
Yes, but before we can talk about how often you should fix a portfolio, we have to establish what happens if you never fix it at all. We need a baseline.
Right, the drift.
Exactly. Let's imagine you build a perfect portfolio in January 1962. 60% stocks, 40% bonds. You put it in a drawer, lock it, and literally do not touch it until 2024.
Well, if you did that, your perfectly balanced 60/40 portfolio would have drifted to roughly 97% stocks and 3% bonds by 2024.
Wow, 97%.
Yeah, it effectively became a pure equity portfolio. And you wouldn't have even needed to wait that long. It crossed the 80% equity mark by 1981.
Which is just 19 years in.
Exactly. Over the entire 63-year sample, that untouched portfolio spent 36% of its trading days sitting above 80% equity. It was a stock portfolio wearing a balanced fund label.
Okay, let's unpack this because I am looking at the terminal wealth numbers for that exact scenario, and I have to challenge this whole premise.
Go for it.
If I took $10,000 in 1962 and did what the experts say, right? Let's say I rebalanced it annually to keep it at 60/40. I end up with $1,969,000.
Which is an amazing retirement.
It is. But if I did your lock it in a drawer, buy and hold strategy, doing absolutely nothing for 60 years, that $10,000 turns into $2,659,000.
That is correct.
Wait, hold on. That is $690,000 extra for doing nothing.
Yes, it is.
I mean, I can buy a lot of risk management in my personal life with an extra 690 grand. Are you telling me that avoiding a temporary drop on paper is worth giving up $750,000 real dollars? Why wouldn't I just never rebalance?
Well, what's fascinating here is that you are falling into the classic trap.
Yeah.
You're looking only at the raw return and completely ignoring the path you took to get there.
Okay, fair. But it's a lot of money.
It is. Yes, you made an extra 690 grand.
Yeah.
But you got paid for risk you never actually signed up for. Let's talk about the drawdowns.
Right. The crashes.
Exactly. That unrebalanced, purely drifted portfolio had a massive 46% maximum drawdown. At its worst point, nearly half your wealth just evaporated.
Oh, wow.
Compare that to a 31% drawdown for the annual rebalance.
I mean, 46% is terrifying if you're about to retire, but still the raw cash at the end.
Well, let me stop you there, because the Sharpe ratio tells the real story. Remember, that measures how much you are getting compensated for the sleepless nights.
Right, the risk-adjusted return.
Yes. The buy and hold strategy had a significantly lower Sharpe ratio. It was 0.438. But the annual rebalance gave you a Sharpe of 0.487.
Ah, okay, so the ride was way worse for the unrebalanced one.
Way worse. You were taking on wild, unmanaged equity risk just to chase that terminal number. Rebalancing is fundamentally a risk management tool. It's not a return enhancer.
So you don't rebalance to make more money?
No, you rebalance to ensure you are actually driving the reliable sedan you bought, not a race car that might fly off a cliff the first sharp turn.
All right, point taken. I mean, you can't spend terminal wealth if you panic sell at the bottom of a 46% crash because your portfolio secretly became 97% stocks.
Exactly.
We must rebalance to control the risk. So if doing nothing is driving blind, how often should I check the mirrors? Because if we listen to the financial industry, the standard is monthly, maybe quarterly.
Right. You get those nice, neat monthly statements showing your advisor hard at work, keeping your pie chart perfectly sliced. But let's look at what the data actually says about calendar frequencies.
Okay, let's hear the numbers.
We looked at the gross Sharpe ratios for that plain 60-40. If you rebalance every single day, your Sharpe ratio is 0.468. But you generate a massive 89% annual portfolio turnover.
Wow. You are constantly trading.
Constantly. Now, what if you do it weekly? The Sharpe is 0.469.
Basically the same.
Exactly. Monthly, the industry standard, still 0.469. It just drops to about 21% turnover. Quarterly ticks up slightly to 0.482.
And annual.
Annual rebalancing, the absolute laziest rule on the calendar, actually wins. It delivers the highest Sharpe ratio at 0.487, with a tiny 7% annual turnover.
Wait. Whether you trade every single day or just once a month, the risk-adjusted return is virtually identical.
It's statistical noise. The spread from the absolute worst rule to the best rule is just 0.019 Sharpe.
That is crazy. You have a 250 times variation in how often you trade, and the only time you see a meaningful bump is when you stretch it all the way out to once a year.
Yep. And remember, those numbers are gross of costs. That is purely theoretical. If we introduce the reality of trading costs, the picture gets dramatically worse for the active approach.
Right, because trading isn't free.
Exactly.
Yeah.
Let's assume a tiny 10 basis points for a one-way trading cost, just 1/10 of 1%. The daily Sharpe drops down to 0.459, but the annual Sharpe, it barely flinches. It stays up at 0.486.
Oh, wow. So the lazy way ignores the fees because it barely trades?
Precisely. Quarterly is incredibly resilient, too, at 0.481. And if you increase the friction to 25 basis points, daily rebalancing just bleeds value. It drops to 0.444.
Let's translate this into actual dollars because this completely blew my mind when I saw it. Remember our two hypothetical investors starting with $10,000? The guy who listens to conventional wisdom and rebalances monthly ends up with $1,836,000. But the guy who just checks his account once a year,
He gets $1,969,000.
yes. Monthly rebalancing literally leaves you with the lowest terminal wealth among all the rebalance strategies. It's wild.
It directly challenges the entire industry narrative that more oversight equals better outcomes. Less frequent rebalancing means less turnover. And critically, less drag from selling your winners.
Here's where it gets really interesting to me. Over-rebalancing a portfolio is like constantly pruning a plant before it has time to grow.
That's a great way to put it.
Because momentum is a real phenomenon in markets, right? When stocks go on a run, they tend to run for a while. When you rebalance monthly, you are aggressively clipping the leaves off the plant every time they sprout.
You are fighting momentum for absolutely no reason.
Yeah. Annual rebalancing lets that momentum run just long enough to capture the upside before you hit the reset button.
That is a perfect analogy. You need to let the asset breathe. You want the growth. You just don't want the dangerous drift. Annual gives you the best of both worlds.
But wait, trading just because it's January 1st seems completely arbitrary to me. What if the market has barely moved all year?
Right, you're just paying a fee for no reason.
Exactly. I'm paying a transaction fee because the Earth completed a specific rotation around the sun. Shouldn't we only touch the portfolio when it actually breaks out of balance?
This brings us to threshold bands. And for an unlevered portfolio, This is arguably the one genuinely useful trick you can deploy.
So instead of watching the calendar, you watch the drift.
Exactly. If we use a 7.5% threshold band, it means you only trade when your equity weight drifts 7.5 percentage points away from your 60% target.
So if stocks climb to 67.5% or drop to 52.5%, then and only then do you act.
Right. And the math on this is incredible. Using that 7.5% threshold, you get a 0.483 Sharpe ratio. It's practically tied for the top spot with annual.
But the turnover is tiny, right?
A tiny 6.4%.
Uh-huh.
Over 63 years, doing this resulted in only 26 trades.
26 trades in over 6 decades? Compare that to the standard monthly calendar rule, which boasts 754 trades over the exact same period.
For a regular listener, 26 trades in 63 years translates to roughly 1 trade every 2.5 years. Think about the efficiency gain there.
Especially if you are in a taxable account where fewer trades mean fewer taxable events, you are getting the exact same risk control as the hyperactive manager, but with a fraction of the friction in taxes.
Exactly.
I love it. Lazy, tax efficient, and mathematically superior. But, and I know this is coming, I know the quants out there are screaming right now.
Oh, absolutely. They want the complex models.
Yeah, they're saying, what about the smart rules? What about volatility triggers? Like rebalancing when the 60-day realized volatility spikes to 16 or 24%.
Well, drawdown triggers.
Right, rebalancing aggressively when equities fall 5, 10, or 15% from their peak. Because buying the dip sounds like a brilliantly sophisticated strategy.
Well, it sounds brilliant in a pitch deck, but it is a complete mirage in practice. If we connect this to the bigger picture, a 5% drawdown trigger sounds like you are perfectly timing the market stepping in to buy cheaper stocks.
Right.
But let's look at the actual data. Over our 63-year sample, a 5% drawdown trigger generated 7,290 trades.
Wow. You are practically day trading during corrections.
Exactly. And after all that effort, the Sharpe ratio was 0.478, lower than just lazy annual rebalancing.
So you're catching falling knives and paying a transaction fee every time you bleed. 7,000 trades just to underperform someone checking their account once a year.
Drawdown triggers basically amount to poorly timed contrarianism. Crashes don't happen in a single day. They happen in stages.
Right, they draw out over months.
Yeah, so when you have a tight drawdown trigger, you are buying into every single dip, including the ones that just keep falling for another 6 months. It creates these massive, expensive bursts of rebalancing during crises.
Which just eats your returns and costs.
On average, the timing adds absolutely nothing. The data is definitive here. More complexity just meant more trading costs, not better risk-adjusted returns.
Okay, so far from our retirement account, the rule is to step away from the keyboard. Being lazy is the ultimate portfolio hack.
For a standard 60/40, yes.
But what if we're not talking about my 401k? What if we're talking about a multi-billion-dollar risk parity fund? What happens if you take the exact same 60/40 asset allocation, but you turn up the volume using leverage?
This is where we uncover the second major, non-obvious finding of the study. And this is the bombshell for the professionals listening.
Let's get into it.
Let's look at a 1.5 times levered 60/40 portfolio. That means you are holding 90% equity, 60% bonds, and you are financing that extra 50% by borrowing at the 4.5% average treasury bill rate.
Okay, so if lazy is better for normal portfolios, I'm guessing levered portfolios should be locked in a vault for a decade to avoid all that momentum drag.
Actually, the answer reverses completely.
Wait, really?
Completely. For this levered portfolio, daily rebalancing is the absolute best. It gives you a 0.474 Sharpe, and annual rebalancing is the absolute worst, plummeting to a 0.352 Sharpe.
Oh, wow.
That 12 basis point spread is 6 times larger than the tiny spread we saw in the unlevered portfolio.
Wait, same assets, same target weights, but the exact opposite rule. A minute ago, daily trading was destroying my returns with friction. Now it's the optimal move. Why does adding leverage suddenly mean I have to micromanage the portfolio every 24 hours?
There are 2 driving forces here, and they are mathematically unavoidable. First, leverage amplifies drift exponentially.
Okay, how so?
Well, in a regular 60/40, a 2% daily stock move shifts your overall equity fraction by a tiny bit. But with a 1.5 times levered portfolio, your positions are significantly bigger relative to your actual net asset value.
Ah, I see.
So over a month, that levered portfolio can wander wildly away from its target leverage ratio.
Yeah.
You end up accidentally running 2 times leverage right as a crash hits, or dropping to 1.1 times leverage during a massive recovery.
That makes total sense. It's like taking out a mortgage on a house where the bank changes your interest rate and your loan size every single day based on Zillow's daily price estimate. If you don't adjust it constantly, the bank ends up owning the house before you even realize what happened.
Precisely. The math trap is deep.
Mm.
But the second force is even more important, and this is what professionals call Jensen's inequality.
Okay, convex math.
Right, but I can explain it without the textbook jargon.
Yeah.
The volatility drag of leverage is mathematically convex. Think about simple percentages. If you lose 50% of your money one day, you need a 100% gain the next day just to get back to zero. Leverage amplifies that math trap.
Because the swings are bigger.
Exactly. If you rebalance infrequently, your leverage randomly oscillates between, say, 1.3 and 1.7. The mathematical reality is that oscillating randomly around an average will consistently produce worse compound returns than simply maintaining a steady 1.5 leverage.
Because when the leverage drifts too high during a drop, the hole you dig is so deep that the rebound can't save you. You are literally bleeding your compound annual growth rate, your CAGR, just by letting the leverage ratio bounce around.
Yes. Daily rebalancing keeps the leverage incredibly tight and minimizes this convexity cost. The difference in annualized growth between daily and annual rebalancing for this levered portfolio is almost 1.6 percentage points a year.
That is massive over time.
Over a decade, that is a 17% cumulative shortfall if you use the lazy annual approach. And incredibly, the annual strategy actually has a lower max drawdown than daily for the levered portfolio.
Wait, how is that possible if the returns are so much worse?
Because annual rebalancing lets leverage decay between rebalances. If the market is crashing, your net asset value is dropping faster than your assets, effectively deleveraging you during market turmoil. But you pay a massive, unacceptable price in your long-term returns to get that accidental safety.
The takeaway here is profound. If you run risk parity or any kind of levered portfolio, daily or weekly rebalancing is not just some annoying administrative overhead.
No, it's not.
It is a structural necessity to prevent leverage decay. You have to do it, or you destroy the very premium you use leverage to capture in the first place.
Exactly. For the unlevered portfolio, rebalancing is just a risk management tool. For the levered portfolio, managing the drift is the whole game.
Wow. Okay, so we've solved the mechanics. Unlevered, be lazy, let momentum work. Levered, be obsessive, fight the decay.
That's the summary, yeah.
But how much does all this mechanical fine-tuning actually matter compared to the macro environment you're standing in? Because the study also broke the data down decade by decade, and the reality check here is staggering.
It really puts the whole debate into perspective. If you were a regular 60-40 investor in the 1990s, rebalancing monthly, you enjoyed a Sharpe ratio of 1.60. You felt like a genius.
I bet.
But if you took that exact same allocation and the exact same rebalancing rule into the 2000s, your Sharpe ratio for that entire decade collapsed to just 0.31.
From 1.60 down to 0.31. You went from printing risk-adjusted money to barely beating a zero return. Same strategy, totally different universe.
And the critical driver of that difference wasn't how often you traded. It was the correlation between stocks and bonds.
The regime shift.
Exactly. From the 1960s all the way through the 1990s, stock and bond correlations were actually positive. They ranged from 0.10 to 0.29. When stocks went up, bonds generally went up, and vice versa. But in the 2000s, especially the 2010s, that correlation flipped. It went deeply negative, hitting negative 0.44.
Meaning, when stocks crashed, bonds rallied hard. They moved in opposite directions.
Exactly. And that negative correlation is what made the 60-40 portfolio such an incredible, almost magical hedge during those years. When you rebalanced, you were automatically selling high-priced bonds to buy dirt-cheap stocks at exactly the right time.
Right, because they were moving inversely.
But in the 2020s, we've seen that correlation drift right back toward zero, sitting around negative 0.06 today.
So the frequency of your rebalancing is really just fighting over crumbs on the table. The real driver of your wealth is the regime you are living in.
Absolutely.
If the regime gives you a tailwind with negative correlations, you look like a superstar. If it gives you a headwind, no amount of mechanical calendar tweaking is going to save you.
The overarching asset allocation decision and the macro environment completely dwarfs the rebalancing frequency decision.
This has been an unbelievable deep dive. Let's pull it all together because we have two very different listeners today.
Sounds good.
If you are a regular investor, maybe you've got a normal 60/40 in your 401k or IRA, the industry standard monthly rebalancing is slightly suboptimal. It actually costs you money. The data says lazy is optimal. Check your portfolio 2 to 4 times a year. If your stocks haven't drifted more than 5 to 8 percentage points away from your target, do absolutely nothing.
And if you are dollar cost averaging by adding money from your paycheck every month, just use those new contributions to buy whatever is underweight. You are perfectly fine.
Good point. And for the professionals, the PMs and allocators, if you use leverage, the rules entirely reverse. Leverage demands daily or weekly discipline due to Jensen's inequality and amplified drift. Do not let your leverage ratio wander or the math will eat you alive.
And for everyone, institutional or retail, skip the smart drawdown triggers. They fail net of costs and just generate massive turnover by catching falling knives.
Right, most of the busy work we stress over is just that busy work. But before we go, you brought up that correlation shift in the 2020s. Give us one last thing to chew on, because that felt like a warning.
Well, it raises an important question for anyone listening. If the stock-bond correlation regime is shifting back to positive for good-meaning stocks and bonds fall at the exact same time, just like we saw in 2022, then the diversification magic of the 60/40 portfolio itself might be fundamentally broken.
Oh, man.
It won't matter how perfectly you optimize your rebalancing threshold if the two assets aren't actually hedging each other anymore. Are you prepared for a world where your portfolio's primary shock absorbers suddenly stop working?
That is a terrifying but necessary thought that's like perfectly following that oil change sticker on the windshield while completely ignoring the fact that the road you're driving on just turned into a cliff. Thank you for joining us on this deep dive. Take a look at your own portfolios, reconsider the busy work, and we'll see you next time.